All right, everybody, this isn't going to be fun. This is my worst day ever for this portfolio. The Fed just announced interest rate hikes and then some commentary around it. We're going to talk about that. The entire stock market is crashing. The market was down before the Fed announced this, and now it's just down way worse. You can see this here. You don't need to see all of these stocks. You can just see all of the red here and then the big ones, right? Microsoft is down 2.8%. Adobe is down almost 4%. Google's down 3%. Meta is down 4%. The stock's down like 80%. How can it keep going down? It's just crazy. Amazon is down 4%. Tesla's down 5%. If you are invested in the stock market and you're not short, your portfolio is hurting. I'm going to share what my portfolio is doing, how I'm going to handle this, and my plan for moving forward, and what I'm going to do, if I'm going to sell everything I own, if I'm going to add more. Right, so here's the headline. Fed approves a 75 basis point hike to take rates to the highest level since 2008, and they hint at a change to policy ahead. So you would think that might be positive. If they're going to change their policy and stop hiking interest rates, the idea going into this was that that would be good because it would help the market. But now the market either already priced this in or seems to be spooked. Maybe it fears that there's something bad coming for the economy, and that's why they're going to change their approach and stop hiking so much. Or maybe the market thinks that they just hiked too much and didn't stop soon enough, and they just kind of bought into the rumors or whatever, and now they're selling after the announcement. Who knows? I don't do this short-term trading stuff. I'm a long-term investor, which has not worked out at all for me. Okay, and so we're now at interest rates of 3.75 to 4%, which is the highest level since January 2008. It's the most aggressive pace of monetary policy tightening since the 1980s. Okay, and so this is what they said about changing their policy path going forward. They expanded on the previous language that declared ongoing increases in the target range will be appropriate. And what they changed it to is that the committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. So that is how they clarified it. Initially, stocks rose following that announcement, but then turned negative during Jerome Powell's news conference as the market tried to gauge whether the Fed thinks it can implement a less restrictive policy that would include a slower pace of rate hikes to achieve its inflation goals. So this seems to happen every time. After the announcement, the markets go up, Jay Powell talks, markets crash. And the reason was because he pretty much dismissed the idea that they were going to slow rate hikes or pause them or anything like that. So all of these hopes that people had just went crashing down. And then he reiterated, he's like being a hard parent. He reiterated that it may take resolve and patience to get inflation out. So people don't like that. We still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. So, but then he said that there might come a time to slow. He said that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. So people don't like this indecision, and basically the trouble is no one knows how to read this. No one knows what to expect, and the unexpected is what markets hate the most and what people fear the most, right? So let's just look at the dumpster fire that is my portfolio today, down $6,871 today alone. All in all, that brings us down to $24,000. We are $24,000 down. We started with $131,000. We're down at $107,000. This is the worst the portfolio has been since I started it. And just for fun, let's sort by the biggest losers. We got Meta, Bill.com, Mongo Database, Datadog, Mercado Libre, Tesla. Everything's a big loser, all right? And that's what I get for owning growth stocks, expensive growth stocks. And Meta, which isn't expensive, I think it's undervalued, but it's a shrinking stock, and that one's hated too, right? And so I hope that this level of transparency and showing you the ups, there have been no ups, but the downs, and maybe one day when there are ups, if there ever are, I know there will be at some point, the fact that I have shared the downs this whole time has hopefully taught people a lot of lessons about investing over the long term, and what I think will be a long-term success story and an example of the reason to stay invested and continue investing. I could be wrong about that though, but I'm going to show you either way. If you appreciate that, do me a favor and like the video and subscribe to the channel. that really helps the channel grow. And you may not be able to read these, but basically all the news is negative. S&P, the Dow, the Nasdaq drop, Upstart, Blend Labs, Lending Tree among lone stocks sliding after the Fed rate hike. Zoom Info was a growth stock that slid 30% after they reported earnings. Devon Energy plunges after a payout cut. Block, PayPal, their earnings are coming up. Bitcoin dips after the interest rate hike. It's just all negative. How should we position a portfolio to deal with these interest rate hikes? Is it time to sell? Is this the time to sell? That's what's going through my mind. And I'm not an advisor, make your own decisions, but this is data from LPL Financial. S&P 500 index returns under a higher 10-year yield. So this is just a chart that shows the change in 10-year treasury yields, and the median change is 2.4%. The average has been 2.9%. And on average, in all of these situations with interest rates hiking, going higher, which goes back to 1962, it looks like, the S&P on average has gained 17% during that time. This also has duration. So the average duration of interest rate hike periods has been 26 months. So that's about almost a little bit more than 2 years. Even when interest rates rose 9%, the 10-year treasury rose 9% over a period of 5 years, the stock market was still up. And so that's how the broader market has performed during longer periods of interest rate hikes, right? That doesn't mean that that's going to be what happens now. That's not how it started so far. But then, for me, it all comes down to this chart, right? This is the Dow Jones Industrial Average from 1896 to 2016. Everything you see on this chart, you don't need to read it. It's all panics. It's all bad things that have happened. Terrible wars, famines, pandemics, all kinds of horrible stuff. And so it looks like the Dow has risen from about, 30 or 40 in 1896 to 20-something thousand in 2016. And it's gone up since then, right? And so the point of this is that the market always recovers with enough time. It's just sometimes it takes a really long time. Recovery took 19 years in this scenario, 25 in this one, 16 in this one, 6 in this one. Now we're talking about, 150 years or something like that. So of course there's some bad times. Overall, the market has gone up, right? And so for me, the key continues to be not investing money that I might need in the next 3 to 5 years. I've said that all along, right? So whatever happens with my portfolio is not going to affect my personal life over the short term. The key is to try to maintain my income and keep my job through a recession or something bad happening. One of the biggest risks is losing your job and losing your income and having to dig into your investments or something like that. And then third, just cutting spending and saving more money and living below your means so that if something does happen, you have a cushion. That is my plan, and my plan is to continue investing monthly into my portfolio every chance I get for as long as I can, at least another 20 to 25 years, even if I have retired or I just work and make $3 million from YouTube. My plan is going to be to continue accumulating and buying more shares in stock over the next 20 plus years. That's my plan. I'm not running away from this market.